Tim will take us away.
Which I love.
We're done.
Wow. Okay, I'll just shut up.
Yeah. Now the mics are on. Okay, we're going to get started with the next panel. This is another side of the conversation, another perspective. It's the Buyside panel, navigating the investment landscape for opportunities in disruptive technology. And I have three fantastic investors here to talk to us about what they're seeing. So today we're going to cover a couple things. How are institutions navigating the landscape? Where do they see opportunity? And where do they see institutionalization? And maybe also what advice do they have for companies as we go into 2026? And we also might hit on what are their investors asking right now? What are they looking for? Maybe first, if we could just go down the line, you could each tell us a minute or two about your fund and your strategy.
Great. Hi, I'm Sam Gare. I'm the CIO of Monarch Asset Management. Monarch is a digital asset manager based in New York. We run three core strategies. One is directional, systematic directional, which is what I run. And then we have two market neutral strategies, market neutral dollar, market neutral Bitcoin. The Bitcoin fund obviously is denominated in Bitcoin and aimed at Bitcoin holders who want yield in native currency. We focus mainly or almost entirely on data-driven approach to systematic trading, and we think our directional product that I offer is relatively unique in the space in that we take our high-frequency, low-latency signals that have been in production for close to a decade now, and I've worked with our technology folks and the CIO of our market neutral fund to elongate those signals, to give us essentially longer term, longer horizon, high beta, high sharp sort of signals. We focus on delivering institutional style returns, meaning that unlike typical directional funds in the space, we also focus on protecting the downside as stewards of your assets.
Great, Joe?
Yeah, Joe Carvalho. I run a private credit business at Diameter Capital. We manage today in our private credit business about $5.5 billion in AUM. We have about 80 investments, and we've called about 80% of the capital. So it's predominantly middle market lending, companies as small as 10 million of EBITDA and as large as 1 billion of EBITDA. And so our investment size spans from about $40 or $50 million on the low end to about $1 billion on the high end. Next year, we've been in business for about 2.5 years. Next year, we're raising funds 2 and 3, and so we have line of sight to growing the platform to a $10 to $15 billion platform next year, depending on success of the fundraise.
Great, Patrick?
Patrick Su. I'm a co-founder and partner of BSQ Capital. We're an opportunistic and special situation strategy. We're focused on disruptive tech, including data centers, compute, blockchain infrastructure, and the energy assets that support it. We take capital agnostic approach. We prefer to be senior on the risk stack, so really utilizing instruments such as secured credit, converts, structured and preferred equity, and really looking to deliver downside protected returns with upside through equity-like optionality. Our focus is going to be on cash flowing businesses or yielding businesses, or having some visibility to that through businesses that have or hold underlying assets such as digital assets or physical assets, as well as businesses that have clear catalysts in terms of the next phase of growth. So really where we play is going to be where a lot of the banks and traditional lenders would not go and can't be flexible enough to participate, and then also where the VCs aren't really the right type of capital to invest into.
So Patrick, maybe we'll stay with you. How do you define disruptive technology? Where does it begin and end for your fund?
Yeah, so technology has always been at the forefront of innovation, and at least in the last 30 years, digitization has been a key theme of that. And if we look at technology as from the beginning, at least the internet is a very good starting point, and that's disrupted how information flows. Then we move on to mobile, which has disrupted how communication and access to information has changed. And then there's cloud, which has kind of disrupted how data is stored. Today, we're in a place, in an era where really compute and digitalization of finance and payments are really at the forefront, and what's driving that is sectors such as AI and blockchain. That's where we're focused today because that's where the opportunity set is. And different than previous tech cycles, we're coming through a different phenomenon now where we're actually seeing the convergence of multiple industries, such as you have tech, you have energy, you have real asset infrastructure. And there's just a much larger capital need, but that also means much more complex types of deals when you look at this. So from that standpoint, we really think any kind of emerging tech, there's going to be bottlenecks in growth. There's going to be challenges from adoption, scaling, regulation. It will just have a lot of challenges, and we think actually value accrues at these bottlenecks. And that's where we actually play with more structured instruments and to be flexible to provide the kind of capital or structure needed by these companies or assets in the space.
Great. Joe, Sam, do you agree with how he characterizes disruptive tech? How do you think about disruptive tech?
Yeah, I think he has a little bit broader mandate than what we have in our private credit business. We've looked at investments that span from copper to fiber, infra, both to the home and to business. We've invested in businesses with spectrum value and satellite industry. We have not done much in the crypto space, just kind of given the rate of change in those markets. But what we are spending
We can help.
Yeah, exactly. Yeah. What we spent a lot of time on over the last about a year and a half has been just AI infra. The panel on the last panel, I think, spoke to it pretty well. But I just think the amount of capital that is being invested now, we're just seeing a ton of flow. We have a public hedge fund that focuses on credit, and so there's been a convergence of both public credit investment opportunities and private credit, and so we sit in our company where we benefit from, I think, that convergence. And so we've done a few deals in that space, and that's where we're spending the preponderance of our time right now.
So I think I sit in a little bit of a unique seat in that I have a background in both finance and technology. So prior to me being a CIO here and in my own fund, I was a CIO as an information officer at New York Mercantile Exchange and at FINRA, where I witnessed firsthand and shepherded open outcry to electronic trading, high frequency trading, migrations to big data, and from data warehouse appliances to things like Cloudera, cloud-based computing. And so when I think about disruptive technology, I think about the definition, which is technology that changes the status quo of an industry, technology that disrupts the apple cart, right? Technology that changes fundamental processes and procedures in an industry. So we happen to be in the catbird seat of that in crypto and digital assets. Digital assets are in a super cycle, if you will, the very beginning of a super cycle of a revolution in payment technology. So when we think about this, we think about the convergence of AI and crypto. So if you like AI, you love crypto because AI needs crypto as a payment form, right? And so we look at projects like Tau, for example, which has its own AI compute ecosystem similar to Bitcoin. We look at things like Centrifuge, which takes real-world assets like credit and bonds, et cetera, and puts them on chain. And we think about things that are upcoming, like Canton Networks, which just received investments from, let's think about this, Citadel, Virtu, and somebody that didn't make the headlines on this round of funding, DTCC. So what does that tell you? That tells you that I think on-chain trading and clearing of equities is closer than everybody thinks.
So that leads into institutionalization, I think. What inning do you think we're in adoption and institutionalization?
Sure. In terms of crypto? In crypto,
yeah.
Sure. Everything else is. I think in terms of crypto, in innings, we're probably in the, I'm going to say, bottom of the first. We've really gotten a green light with the Genius Act that's recently been passed, right? Institutional adoption in crypto has soared over the past year with the new administration coming in and for the first time, crypto having a very friendly regulatory environment coming out of DC, which we've never had. And so that's really spurred a lot of innovation and a lot of new projects. Every single major investment bank and money center bank has a stable coin project either in the works, implementing, or about to implement. If you listen to Tom Lee, he's really, really up on this. He's basically saying that we're in this like 1971 moment, and I agree. In 1971, the dollar left the gold standard, and Wall Street innovated around the dollar to keep it relevant and created products, CDOs, CLOs, ETFs, et cetera, over the next decade, and the dollar retained its dominance. Well, I think you're going to start to see that now in digital assets as banks start to innovate on-chain and bring more products on-chain.
And Patrick, do you see that as well? And with institutionalization, do you have any KPIs you look for or more demand from your investors?
I agree with Sam on kind of where we are in the cycle, but I think from institutionalization, we are seeing real adoption starting to happen in the last 2 years. I mean, regulated access points for broader markets to access through ETFs, through corporate treasuries. These are real change, and this is how it scales. We're seeing stablecoin adoption where it's going through traditional payment rails. This will fundamentally change how finance and payments digitize. So, I mean, these are things that are already happen. RWA tokenization, we're just in early days. We are seeing some credit products, with BlackRock's doing one. We have the likes of Ondo. These guys are doing more tokenized treasury bonds, but there's going to be a lot more out there that can be and will happen, but it will take time. So I think the only thing probably worth adding onto this and institutionalization is, I think U.S. tends to lead regulation, and I am based in Asia, but I spend time between the two markets. I'm American, and this is I see the contrast. It's very stark. Everyone wants to innovate, but it has to start with regulation first. And the fact that U.S. is leading this, it's going to happen here first. That's why we're early. Every other market, let's say Korea, Japan, Singapore, Taiwan, all of these other markets in Asia, they're not there yet, and they are waiting to see what happens and how things get regulated in the U.S. first. So to answer your question in a long-way form, I think it's here, but we're still very early.
Sure. And Joe, is there a world where Diameter moves into crypto? You're raising another fund or two?
We could. I mean, we've looked at a bunch of opportunities. I mean, like I said, though, I think right now, from a disruptive technology standpoint, where we're seeing the most opportunities is on just the AI and data center build out, just to kind of put some numbers around it, because I do think it's kind of fascinating. Talking to our analysts today, like current projections are $5 trillion are needed over the next 5 years, right? And so where's that money going to come from, right? The hyperscalers and just cash flow from companies should account for about $1.5 trillion of the $5 trillion, right? And then there's another $500 billion or so that should come from just equity investments. And then the high grade markets should account for about $1.5 trillion, right? So there you're at 3.5, and you have $1.5 trillion shortfall, right? And so where's that going to come from? It's the government, right? It's leveraged lending, so loans, and then structured credit and private credit. And so this is one of the stories of our time where it's not which part of the capital markets are going to win, it's how our deal's going to be structured to access every component and every part of the capital markets.
Can I just follow up on
Sure. Yeah.
on a point? Just to put a statistic around institutional adoption in crypto, more to Patrick's point as well. I like to use statistics because math doesn't lie, right? And so about a year ago, IBIT is the Bitcoin ETF. IBIT options launched. They had zero open interest. At the time, Deribit, for those of you who don't know, Deribit is essentially a derivatives exchange that has about 95% market share in options. Today, now the market share is about equal. Actually, IBIT options have more open interest than Deribit does in Bitcoin terms. And so ordinarily, as a veteran of exchanges, what I would probably tell you is, it sounds like Deribit might be losing market share to to a newcomer. But what's actually happened is Deribit's volume and open interest are the same, if not higher. So maybe they haven't grown as much, but what it tells me is that the pie has gotten larger. And so everybody's taking a piece of a larger pie, and that sort of size does not come from retail. It's coming from institutions.
Right. Yeah, I was about to ask you, what's the split, do you think, retail institution?
On the IBIT options, I don't have the facts offhand. If I had to guess, I'd probably say about 85% institutional,
Yeah.
via hedges, overrights, et cetera. It's been tremendously in vogue, specifically with Bitcoin.
Well, maybe we can start thinking about opportunities that you see ahead in your respective areas of focus. What are you most excited about in 26 and 27 in terms of investing? Yeah,
Sure.
we can start with you.
Sure. So again, we're looking at the convergence of AI and crypto. So we like projects that address this, Tau, Near, et cetera. We really like Hyperliquid is a core holding of ours. For those of you who don't know, Hyperliquid is a decentralized layer 1 blockchain that started as a DeFi exchange. And they spun up about a year ago. I dug into the technology. It's by a group in Singapore out of Citadel that really built a very differentiated platform, kind of out of frustration with the status quo of technology in centralized exchanges or SEXs. And so they built a DEX that gives you a SEX exchange.
Wow.
Yeah, that too. That's coming. But but they built a DEX that gives you a centralized exchange experience. Yeah. And they've gone from essentially zero open interest, and this is a case where they've taken open interest from majors. They've then developed their own layer 1 blockchain, which is now transacted upon, and have come out with improvement after improvement. The tokenomics there, which is something we look for. We look for the core principle of crypto that you really want to look for is fixed supply, permissionless, decentralized, right? That's the core reason for being for crypto. And so Hyperliquid takes 99% of the fees. What exchange do you know that does this? Takes 99% of the fees and buys back their own token. Along with other developments that I can go into, you can tell we're really excited about this particular token.
Very cool. How about you guys? Anything you'd want to share on opportunities?
Well, I've been talking to several companies that have, they're sitting on a pretty sizable war chest of crypto holdings, and now they're using the crypto that they have to go out and purchase, play on the offensive, purchase operating companies, right?
Nice.
And so we've been talking to a bunch of companies about financing those operating company purchases, and I think that is an opportunity set that in 2026 we're going to see more of than we've seen in recent history. So
in this kind of opportunity set that I see, I think generally we don't invest, I think different than Sam, in token direct. We don't take token volatility risk. We like traditional instruments, we like cash flow. We think risk cycles are shorter, so we look where we can actually de-risk quickly, either through recurring cash flow or just tenure. So some areas that are interesting, probably quite contrarian for what's happening in the market is, AI has been very explosive in growth. A lot of the large Bitcoin mining companies have pivoted or converted into AI companies and infra companies, but that leaves a large gap, because even before, there's a large funding gap for these lower mid-market Bitcoin miners who still control the energy, and there's a shortage and scarcity of energy and power assets in the US. So that's still an area we've already liked before. We just think it's going to be magnified as this continues to evolve, and we will still, where we play in the lower mid-market, we'll still continue to finance these companies, partner with them to help them scale, either to continue building, say, Bitcoin mining infra businesses, or to help them grow so they can also pivot and expand into supporting the AI ecosystem because they have the assets. So that's one area that's quite topical, maybe contrarian. Other areas is just broadly blockchain infrastructure. What's changed is now there are more businesses that have more traditional rails that allow it to be accessed. So we're starting to see more cash flows in businesses. We're starting to see more companies become listed, including, you know, I mean, Coinbase has been a while, but let's say more recently Gemini, I mean, the treasury companies, there's just a lot more access points. And if there is really cash flow that we could underwrite, then we also believe they're more bankable in terms of how do we underwrite or attribute value. So we feel it will become more institutional, and there's going to be more forms of capital to support the whole ecosystem. And then lastly, you know, just on more opportunistic, distressed, I know the market today is not, or this last week has been not great, but we do foresee quite a lot of more distressed opportunities that will arise. And I mean, anything that goes through high cycle growth, namely, you know, treasury companies and DATs, that has been one area we see quite a lot of opportunity to come. We don't know what format that will look like yet, but we do think that is going to be a big opportunity.
Well, on that note, I was actually going to bring up, Sam, I think you recently wrote a paper on maybe the evolution of the DAT, or the DAT 2.0. You want to give us a brief on that?
I did, and again, some of the best things come out of frustration. So at Monarch, we were very early to the DAT trade, probably one of the first to be doing this. And we've invested in something north of 24 DATs right now. For the most part, we've done well because we've sifted through low quality, high quality, and figured out a way to rank it. But as I see this market evolving, I coined this term called DAT 2.0. I won't bore you with all the things that the DAT 1.0 companies did wrong, and some of you may be in the room here, so I won't really go into it. But suffice to say, DAT 2.0 is not about chasing a fictional MNAV, which, as a former high-frequency trader, I call MNAV arbitrage bait. So, like, DAT 2.0 is really about increasing the number of tokens per share. That's your prime directive. And you're running a TradFi. This is a TradFi product, a DAT, digital asset treasury vehicle. You have to realize it's a TradFi product, and the real importance to crypto or digital assets is that it's broadening access to people to get returns or get exposure to digital assets, right? And so as a DAT 2.0 operator, a focus on increasing the number of tokens per share. How do you do that? Number one, you want to have a cash hoard. You want to have dry powder to purchase tokens opportunistically, to purchase your stock back when it's at a discount to NAV, because that's essentially a self-fulfilling arbitrage. And then if you want to use an ATM or a flywheel, you can use that when the NAV goes above 1, sell more stock, buy more tokens. And all of these things are either increase the numerator, which is the number of tokens you have, or decrease the denominator, which is the number of shares you have, and you're driving value to your shareholders, which is your primary responsibility.
Well, I was also going to ask, what would you tell companies who want the buy side's opinion in terms of how they could do things better? So you just told us a few things.
Yeah, I think it would really be understand exactly what it is that you're doing. You're operating a publicly traded company, right? And that comes with its own set of challenges.
Yep.
You've got to report to investors, you've got to report to analysts, you've got to talk to auditors, you've got to speak to regulators, you've got to be in compliance. And all of these things are not kind of good when you're doing on-the-job training, right? Yeah. You need people who are experienced at being able to do this. And then your second focus is an operating responsibly. Don't take your cash when you raise it on the first weekend. You announce the deal on Friday, or you close the deal on Friday and announce on Monday. Most 1.0 DATs have gone out and bought all of their tokens, 100% of their cash. They use it in that weekend, and then there are firms, I don't know, like market neutral funds, who might go and sell into that buying because we know that it's over at the end of the weekend. Instead, be rational and responsible with your purchases. Keep your cash hoard or your dry powder for times like, I don't know, when the market goes down maybe, and purchase opportunistically. Buy your stock back. If somebody wants to sell, we used to say this on the trading floor, if people want to sell something, if they really want to sell it, let them sell. Don't help them, but when it's at a price, buy your stock back.
It sounds like a good time to be a recruiter to help put great management teams together. How do you think we're starting to see movement there? So more TradFi people?
We are absolutely starting to see movement there. We're absolutely starting to see a higher quality of operating team come into place. People who are experienced, people who have public company experience, people who know about financials and reporting.
Great. And gentlemen, anything you would give advice? What would you say to companies that want your advice?
To capital raise?
Yeah. Just being public, or going public.
Oh, going public.
Yeah.
Oh, yeah. I mean, this guy hit it.
Yeah.
hit it on the head.
Sorry for taking up so
Yeah,
much time.
no. I mean, I think if you're a public company though, and you want $50 to $1 billion of private debt, just give me a call.
Yeah.
That's what I would tell them.
Okay.
No one better.
Good advice.
Yeah, we're probably not your first call when you want to raise capital, but where we are able to provide more unique and bespoke solutions. So I think really, if there are these situations, be real and be honest with your pain points. Convey that and let us know how. I think we can talk through it and try to work with you, because it's different than many say venture investors. Here's the deal. This is priced. Equity round. Do you want in or out? We'll take our time to actually understand what's the need. What instruments do we create? What structures do we create? And how do we create a solution that will actually be aligned and help you get through this time of need, where it will bridge you from whether it's the next fundraise or bridge you through a time of market volatility.
Okay, and it's Q4, so a lot of funds are meeting with their LPs and they're having their annual meetings. Is there anything you'd share that you're hearing from your investors this year versus last year that's different? Does it go back to institutionalization? What are they worried about? What are you guys hearing?
Well, clearly in crypto, there are a lot of investors who are worried about a lot of things right now. But we speak to our LPs pretty much all the time, so we don't just set up a meeting. But what we're hearing really quickly is that they like the fact that we are protecting the downside, that we are taking that into consideration and kind of evening out our flows. And that's just a core tenet of what we do.
Great. Anything else?
For us, there's been some pressure in the BDC space recently, and so our investors are really focused on marks, right, that we're presenting to our investors, and then just the evolution of PIK interest, right, converting cash pay to PIK pay, and just what that represents in the total portfolio. But when we're talking about disruptive technology, I think what they're focused on is where do we have an institutional edge at Diameter that allows us to invest. There's a lot of specialization in the industry, whether it's fiber optic investing or satellite investing with spectrum underlying assets, or AI data center GPU financing, right? These are all areas where we're competing against platforms that specialize in it day in and day out, and so we're very selective in where we go. And to your point, the way we've been successful in those spaces is around structure, right? Creating flexible structures where we're solving for what we think are kind of the most important risks at our investment committee.
And Patrick, do you concur?
Agree with what Sam and Joe both said. For what I'm seeing with the demand for a lot of my investors is, they want exposure to tech, and it's disruptive tech, not easily understood, but tech has a lot of embedded volatility. And, generally, to be able to deliver something that is more disciplined, risk managed, that's not sensitive to that volatility, is a product that a lot of traditional investors have interest in, because we're long the sector and technology, but we know that it's going to have hiccups, the market's going to be volatile, and sometimes you can't bear that volatility. So creating these structures will allow us to deliver a product that investors want, which is why we're a unique product. And that requires a unique skill set, because structuring and thinking through situations is not it is a unique skill set that is offered. A lot of investors may not take the time or go through that with you. So I think secondly, really they're looking for managers that can understand, underwrite, and price complex situations and sectors, and that's really where we've differentiated. And I think lastly, I think this is a consistent across all private funds, or just all funds, is DPI and is the new IRR. People want distributions. People want they want to de-risk quickly, and be able to see just early cash flows, especially in sectors that, where venture funds, other funds have been locked up for 7 years without any kind of distributions in the past. This is a unique offering, and we're still able to participate in the high growth aspect of these industries.
So I think the common thread here is risk management.
Amen. Well, at Clear Street, we're really focused on risk management, as some of you know, so I agree. Well, thank you, gentlemen, for your time today and for your perspectives. Thanks.
Thank you,
Thank you.
Clear Street.
Thank you all.
Thank you.